Hey there, community bankers. Welcome back to the Correspondent podcast. I'm here with our CEO, Derrick Hetherington, and our guest, Derrick Jackson, who is the Chief Credit Officer at First Savings Bank, Indiana, and one of our speakers at our upcoming credit conference. Derrick, how are you doing today?
I'm doing well. Thank you all for having me.
Thank you for being here. So we wanted to talk to Derrick about some of his experience, not only in lending, but in the training of lending and credit professionals. I know that's a hot topic across functional areas of banks and um, across industries, really, right now. So, Derrick, if you want to kind of introduce yourself, go ahead and tell us about your experience in the lending and the training and education spaces.
Absolutely. So again, Derrick Jackson, I'm the Chief Credit Officer for First Savings Bank. We're a little over a $2 billion community bank headquartered in Southern Indiana. And it's my first banking stint in Indiana. The rest of my career was in the Louisville, Kentucky marketplace, where I worked both at large national banks and moved into the community banking space coming out of the Great Recession back in the 2008, 2009 time period. In terms of the education side of things, I've been a faculty member for Wisconsin Graduate School of Banking for, I don't know, 7, 8, 9 years now, maybe a little bit longer. I've taught at the ICBB's credit conference a couple of times previously. I've taught with the American Bankers Association and have done some work for the Kentucky Society of CPAs as well. So I guess I've been around a little bit on the speaker circuit and have enjoyed that time. Grew up in sales, did most of my career in that piece, although it's almost evened out now with my time in credit. So I joke a lot with my folks that all those really mean, nasty things that you might say about a credit officer, I've probably said them and genuinely believed it, and have now moved on to the credit side of the house where all those mean, nasty things somebody might say about a lender, I've probably also now said those too. So it's been a nice transition and kind of an interesting change when you get the rest of the information and can appreciate the context for why somebody might form an opinion different from the one that seems obvious based on the role that you're serving at the time of your career.
Right, for sure.
Yeah,
And that's an interesting take.
yeah, I know, Derrick. I had an opportunity to take you as a one of the instructors when I went to GSB Wisconsin, and one of the things I kind of took away from that is you could obviously tell there was that experience from being both, the lender and then being on the credit side. And I always kind of found it fascinating when you take somebody who's kind of had both sides of the equation in their past to be able to really break down the importance of communication between the credit team and the lending team, not just in the process of moving credits through the chain, but also just overall policies and culture within what is it that we're really trying to do? What does our policy say that we're willing to do? What's our concentrations look like? Our cost of funds. So I think it was everybody. The more better that communication is between those areas, it seems like the smoother that process will be will work, and then the happier. Obviously, the customers are going to be, the lenders are going to be, the credit analyst and credit team are going to be if they're all on the same page. So I kind of took that away from when I first got an opportunity to take a class with you, and then obviously I felt like I was an important message for a lot of community banks because I feel like even though they're small organizations, sometimes there's a breakdown in communication between what is the company's true policy or their policy doesn't quite meet with what their culture is within the organization. They're really kind of working on making sure that they marry those two things together. What is it we're trying to accomplish, and do our policies say that that's what we're willing to do? And then communicating that in a way so everybody, the lenders, credit analysts, the loan committees, and everybody that are in place to make sure that these requests flow through and don't create those moments where you're mad at the credit team because policy says we'll do this, but you won't do it. Or the credit team getting mad because the lenders are sending them a bunch of stuff that doesn't make sense with what the culture says they'll do. But they're doing it because the policy says that, hey, I can submit this, so I'm just going to throw it out there and see what the credit team will approve. So that's why I always feel like having somebody like you that has that real world experience on both sides and bring that to community banks, kind of talk to them about your experience, what you found that works, and how to kind of get rid of those, man, that credit team, they just want to turn down everything. Oh, that lender, all he wants to do is just send me every credit and hope I approve it. So as you kind of like look at your approach to what you do at GSB, at the ABA, or any of these different conferences and stuff you speak at, What's that one thing that you think the bankers should be looking at as far as educating their staff, involving them in the conversations, and best practices they can put in place to help develop that culture and policy to make sure that those things kind of align?
Yeah, that's an important question. I think the role that you're speaking to has a big impact in how you might go about training it. The level of knowledge and complexity that the lender might need to understand might be different from that same level of knowledge and complexity the analyst might need to understand. So, I think unpacking that question, and I think there are some foundational truths that every bank has to answer for itself. And the first one is, what is it I want this role to do? How does this role define success? And if the team has a clear understanding of how their role fits within the overall picture, to say, gosh, if we can accomplish these objectives, then we'll be successful within our unit. And that success in our unit allows the bank to be successful as an organization. Then you end up getting everybody, and you'll always have some tension between credit and sales because we serve a little bit of a different master trying to get to the same endpoint. But you'll never have anything more than that. It'll be maybe some tension, maybe some friction, but you'll never have anything that resembles outright conflict. And I think that's important. I think that training and development program becomes critically important to start with a realistic assessment of where your people are. I mean, a very topical conversation that might be interesting for some of our banks to think about is if you walk into your credit team right now and you ask all the credit analysts who thinks that 5.5 or 6.25% is a really high interest rate, you're going to have a divide based on age. If your credit analysts are in their early 30s or younger, this is the highest they've ever seen interest rates ever in their entire career. And then you're going to have the guys with the gray hair or bald spots like I've got that are saying, gosh, we're not even back to normal rates yet. So these exercises we have the analysts jump through, these things like transaction level stress testing, where we say, hey, you should increase that interest rate by 200 or 400 basis points and look what kind of interest rate sensitivity you have. That's been an academic exercise for many of those analysts for the last decade. And they've had no life experience to be able to say, and here's why that matters, and here's why that's important. And by comparison, many of our more experienced bankers that have had those life experiences, they've kind of lost touch with why that was necessary because it hasn't been relevant for so long. So I think we're at this interesting time in the economy where a lot of these things that many of us have viewed as nothing more than an academic exercise for the last several years is now becoming a real life application. That loan that you did a year and a half ago that was on a 5-year balloon note, and at the end of 5 years, you're going to reset the pricing. Your 125 debt service coverage ratio 5 years ago at 3.75% fixed for 5 years looked really good. What's that going to look like, all of the things equal, if their reset rate is going to be 6.5 or 7? Your 125 or 135 debt coverage ratio is probably not as strong as it used to be, if it even covers it. So, you've got these trainings that people have gone through, and they've gone through all the academic exercise. And I think we're at that point now where some of the more experienced bankers need to be able to sit down with some of the next generation of bankers to say, here's why that was so important for us to understand. Here's how we can use that to help make sure we make our borrowers aware and educate the borrower on, here's why you should be thinking beyond just the immediate interest rate. And so just as one example. But I think it comes back to that context. What is it that you want the team to accomplish, and how do you define success for them? And then let those definitions drive what kind of education plans you want to have for each of those groups.
So do you have, like, for your team, obviously being the chief credit officer of a $2 billion bank, you probably have a pretty sizable team with, like you said, that diversity of age and experience built within that group. So what do you do as far as best practices for identifying the needs of your individual employees, and like maybe some tools or resources that you find to be very valuable at those different levels to kind of make sure that everybody's kind of growing and getting that continuing education?
Yeah, great question. So we try to avoid a one-size-fits-all approach. So for each of my managers, I require of them and I require of myself that we meet with all of our employees every 90 days. And part of that conversation is to talk specifically about, hey, in your inner voice, that voice that nobody sees, the one that doesn't make it into the credit memo, where is it that when you get that deal, that in your inside voice, you're going, oh my gosh, I don't know what to do? Because when all you're doing is reading a credit memo, we don't see that internal struggle. We don't see that internal strife. We only see the output. So we might not know that for them to reconcile whatever that piece of information was, they spent 4 hours doing Google and YouTube searches trying to figure out what to do with it, right? We don't see that side of the struggle, and that struggle can be very real for people. So we try to have a formal setting where every 90 days, once a quarter, we're sitting down and just saying, hey, let's talk about what's going on. What are you doing well? What do you think you have your arms around? Where do you need help? Where do we think you might need help? And then what can we do to bridge that gap? So for us, we do have it in a bit of a formal process and try to really take a coaching approach and coaching mentality to it. And that's led to a wide array of resource. So the Kentucky Bankers Association does have some nice resources out there. The Indiana Bankers Association puts a lot of nice resources out and available. There are senior lending organizations where you can have a committee or a group of senior lenders that can talk through issues. On the training front specifically, we have found kind of a hodgepodge of things that we use. So we use the Omega credit curriculum. I find that for a formal organized training, it does a really nice job of getting into an appropriate level of depth for different content. We've got a number of webinars that we've purchased the DVDs on. So when I have a new employee, we've got in-house training that we can get them kind of out of the cradle into proficiency. I've got a couple of folks that are dedicated specifically to single tenant net lease commercial real estate. And for that group of people, there's absolutely some credit risk that we have to teach them. But for that group, we actually send them to some of the CCIM courses, which stands for Certified Commercial Investment Member. That's a commercial real estate designation. It's got nothing necessarily to do with banking, but almost every MAI appraiser that you've got on your approved appraiser list has probably taken some courses from CCIM. So we try to be thoughtful and deliberate in our approach to training and think about what really is the best in class provider for this particular content. And it might be outside our industry. It might be the commercial real estate industry. It might be the Appraiser Institute. So we try to be very thoughtful about who do we think would give you the right knowledge based on the needs that you have for the role that you're serving for the organization.
Right. That makes a lot of sense, and I think that's a great perspective to have being in charge of a department like this. What I'm curious about from what you've said is if you have any training collaboration between your credit team and your lending team. I know you mentioned them potentially being at odds in certain institutions and certain cultures, just kind of depending on how things are framed. But, there's also some overlap there. So I'm curious if there's any overlap or cross training between your credit and your lending teams.
We have, as part of our loan committees, we will frequently bring items in for loan committee discussion. And that serves as kind of a bridge between those two groups. Our credit team doesn't really go through the sales training kind of curriculum or items that the commercial lenders would go through. And in our culture, our commercial lenders do a fair amount of the credit work, but then they tend to pass it off to the credit team to get everything packaged and parsed into the credit memo format if it's a committee level deal. So they do work all of their own deals up to a certain point. So there is some overlap. We always have, especially for things like webinars or recorded presentations. We make those available broadly to whoever would like to go. I didn't mention this earlier. We run a mock loan committee with our credit department where I take my credit analysts and I force them into the role of being a salesperson. So I will give them a deal and their job is to sell the deal to the committee. And I'll take some other member of my credit team and I'll make them be the chief credit officer and make them think through the lens of what's this mean for the allowance? What's this mean for risk-weighted capital? What's this mean for how it fits in the concentrations of the bank? So we try to do things like that to expose them. I bring that up only to say that one of my analysts was talking to one of our commercial lenders about that mock loan committee. And my lender's response was, hey, can I get invited to the next one of those that you run? So I think there may be more opportunity than even I was aware of, because I really didn't think our lenders would be excited about the idea of having role reversal played where they had to start diving deep into a credit and argue the credit side of it instead of the lending side. But at least one or two of our lenders, I think, have some interest in doing that. So just being open-minded to the opportunities and creating the platform and availability to say, this is what our team has. We've signed up for it. Anybody that would like to attend is welcome.
Interesting. Yeah, that's a really interesting way to go. Do you find that having your commercial real estate lenders work that much of their own deals on the credit side? Do you think that makes things run a little smoother or alleviates potentially some of that tension?
I think so. And I think so much of that really comes down to that basic question. What does success look like for your credit team? Are they celebrating when they get a deal restructured, or are they celebrating when they get a deal done? You know, one of the things that I talk with my group about is the credit admin function, especially as it relates to working on approvals. We sit at the kind of the back end of the front third of a loan origination process. Our job is to get a package underwritten and prepared and presented to a committee so a decision can be made. And what that means is every day of delay that we create has an exponential effect on the total experience the customer has. So our folks hear me talk often. There is a real live human being that's waiting for us to make our call, waiting for us to make our decision. Because after we're done and we get it approved, we still have to wait often for appraisals or title work or environmental results to come back. And there's often more questions after that happens. And then after you get through all of that, you have to go through the loan documentation process, especially if we're working with outside counsel. So if we cause a 30-day delay on the front end of a deal, that means the deal is a 60 to 90-day total experience for the customer. And for our organization, that's unacceptable to us. We're looking for speed to market and certainty of execution. And what that means is that our credit team has to be aligned to those goals. We have to understand that our pace and our tempo matter, and it matters not just to the bank, but to the customer experience at the end. And so our training reflects that. Our training reflects how do we get the maximum amount of value that we can get off the financials that we've received, and how do we start distilling between the must-have information and the would-like-to-have information. So that feeds into how we think about our training curriculum and what we try to look for success.
Yeah, absolutely. It's interesting that we've kind of taken this conversation in the direction of training lenders and training credit teams, because we've had a couple of podcast episodes more on a general HR note, and training has come up more than once as something that contributes to employee retention and employee engagement, because especially in banking, I feel like no one wants to feel like they're in a dead end role. So I'm kind of curious if that, time and money investment in training, like how you've seen that pay off among your, credit and lending teams. Is it kind of helping your lending bottom line? Is it helping your retention and engagement and things like that? How have you seen
Um,
that play out?
uh, yes to all. Our bank's asset quality is very strong. Some of that based on deal selection, some of that based on quality of lender and quality of analyst. In terms of retention, uh, I have an employee today that has come to my office and told me, hey, I've had an opportunity that I could have gone somewhere else, but um, combination of the culture that we've created and the fact that they can see continuing investment going into them. When they talked with the other bank, they asked about the opportunities for training and advancement. And what they were told is it's all on the job, and there was nothing formal about it. And this employee self-recognized the value of having an organization that was willing to continue to invest in them. And, that was encouraging for me. Now we'll lose people. I mean, that's just part of the deal. There will always be a bank that's willing to pay more than you're willing to pay even if it's the same size, because they may have a need that's more urgent than the need that you have. Or they may just decide that, hey, it's time to up our game and go get somebody. So, we know that we're going to lose a few people, even though we've made that type of investment in them. But I can also say at least two members of the team that I have today joined my organization because I gave them an upfront commitment during the interview process to continue an investment in them as an individual, and gave them assurance and beyond just we'll give you a webinar once a year type of assurance, that we'll have a continued investment into them as an individual to help them grow their skill set. That's been, for one of my folks, we gave them a opportunity to get their certification in credit risk management from RMA, which is acronyms of CRC. I've got a couple of those that work for me now. I've got another employee that hopefully later this year will pass their final comprehensive test to earn their CCIM designation. So we value that here. It's important to me as a leader. It's important to our organization. And we get intangible value. I've had conversation with our examination teams, and one of the comments that they've shared with us is they take great comfort in knowing that we have a very well-equipped credit team. Does that always translate? No, not necessarily, but I do think I've gotten the benefit of the doubt a couple of times because they've felt comfortable or confident that we have people that understand what they're doing. And if there was an error that they thought was maybe they decided differently, it becomes a conversation versus an edict. And there's no way for me to prove or document that, just a suspicion based on conversations.
Right. Yeah, that makes a lot of sense. And I think that kind of continued investment in education is something that, job seekers across industries and across, banking areas are looking for. But it seems like there is a particular maybe need or demand for it, just from our conversation so far, even in credit and in lending. Do you see that?
So when I got out of college, National City Bank, Chase, PNC, they all had officer training programs.
Right.
All of those seem to have stopped in the early 2000s. And increasingly, at least in the Louisville, Kentucky marketplace, I can't speak to some of the other areas that are probably represented on this call, but many of the big banks have taken their credit teams and moved them to wherever the corporate headquarters may be. So you don't have, while you do still have a number of salient training programs on the commercial lending front, you don't have the same depth of training that used to be available in many marketplaces for the credit side of banking. That's where I think your conference plays an important role. I think that's where programs like Omega and RMA and the Kentucky Bankers Association and the Indiana Bankers Association and the ICBA, that's where all those associations really are adding value, is bringing some of that credit acumen beyond just the commercial lending side to help develop the credit side of the bank. It's not as prevalent as it used to be. And I don't know, Derrick, you've got a little bit wider reach than I've got given the scale of your organization. But do you have any thoughts on that? Are you seeing something similar from a broader context?
No, I think you kind of your background and mine kind of mirror, as far as coming up through those training programs at a larger kind of regional bank, and then as merger activity in the larger regionals kind of took place, the importance of that management training program, like a National City Bank or PNC or BB&T, and some of those that I knew when I came out of college were recruiting me to come join them and go through one of those programs. And the career paths that were in there, like you said, you got to a certain point in that training where then you broke off and you had different career paths that really focused on specializing, whether it be on the credit side or more on the business development, commercial lending side, or retail management, or personal finance and investment. So yeah, I don't see those as being widely available as they were 10, 15 years ago. So I do agree that it used to be you go to a large bank and get your training, and then you go to a smaller bank and apply it to community banks. Like they were kind of a place for people once they got burned out, working the grind at a larger bank and getting their education and they're earning their stripes. we kind of fall back to a community bank and bring a ton of expertise and knowledge and training and stuff. And it just doesn't seem to be as widely available from what I can see either. The one thing I kind of, a lot of our community banks, like obviously your institution at $2 billion is a pretty sizable community bank, where we have some community banks are rather small. So their commercial lender is their commercial underwriter, which is sits on their loan committee. So
Absolutely,
when
yeah.
you're wearing multiple hats, the one thing you kind of talked about today that I thought was pretty interesting was that idea of using like the CCIM certification as a way to enhance knowledge and continued education outside of your normal banking kind of avenues. Because I mean, most of our community banks have a very high portfolio of commercial real estate. That's one of the biggest things that a lot of examiners and regulators kind of look at, is if you get to a certain threshold of commercial real estate in your portfolio or a certain concentration there, that kind of throws up some red flags. So obviously, I think as you kind of look at where your risk is at, breaking outside of just your normal kind of just asset quality management, to say, all right, what are other things that I should be doing to further my education to better assess this portfolio? I think a CCMI certification or designation would be a great avenue, especially for a commercial real estate lender or underwriter. So yeah, I like that. I think I may take that to myself and start looking at ways we might be employ that within our organization.
Yeah, it's been kind of fun for me. So I don't know how many different classes I've sat in that talk about how to calculate a debt service coverage ratio or a fixed charge coverage ratio or a loan to value. For those of us that are at the level in your organization where you're interacting with your allowance and you're having to start talking about things like discounted cash flows, I learned how to do discounted cash flows in CCIM 101 with no idea that that was going to become such a pressing thing for me to have to understand for CECL and other considerations in banking. But that's something that I learned from the real estate perspective and then was able to apply in the banking arena. And I'm yet to go to any class at a banker type organization that talks about things like, here's how you would do a discounted cash flow for your organization if you were trying to do the loss given default based on a series of future cash flow streams. It's a different approach, but many of the concepts are directly applicable. And Derrick, your point on commercial real estate is actually why I started looking at CCIM. We talk about things like capitalization rates, and I think many bankers have a good grasp on what they are, but do you grasp it the same way that your developer understands it? Do you grasp it the same way that your real estate investor understands it? They're looking at cash on cash return. Are you thinking through the same optics they're thinking through it? I think so many times you've got two approaches that I've seen banks take to training and education and personal development. There are those banks that view it as an expense, and the other set of banks that view it as an investment. And I think that really comes down again to that. How are you defining success for your groups? Our organization chooses to view that as an investment that will pay dividend over time. And I have worked at some organizations, particularly some of the larger banks, that viewed it all as an expense that didn't have a dividend back. And the CCIM, not that I'm necessarily advocating strongly for that, but if you send one of your folks to one of those classes, the people that are likely to be surrounding them are real estate brokers, real estate developers, and appraisers. All people that as a banker you should be interacting with.
Right. And I think that's the one thing that, I like about having these conversations with, members of our community like you, that are out there looking at other ways to enhance our understanding of the risk within these credits that we're looking at. And the perspective of, commercial real estate from a lending perspective is completely different than a broker or a commercial investment member who's out there investing in these properties. And that's, I think, the disconnect. And if we could, I like the idea of having a better understanding of their perspective of how they're looking at these deals to help break down that barrier of communication. Because when they come to you and say, well, I've got a $6 million property, but you're looking at a 4% cap rate, you're like, well, interest rates environment where it's at, does this cap rate really make sense? Do we truly have the collateral we want. Well, if you can have a better conversation from their perspective on why is it that that cap rate's at 4%, and what is it in the market that's driving that or dictating that. I think it helps to alleviate some of those, borrower, lender conversations sometimes, and the disagreements that you sometimes run into, especially in the climate and environment we've been in over the last, probably, 8 to 9 months with these rate increases that we've been seeing. So you did
Certainly.
mention.
It can also equip you to talk about some, again, salient topics that can be really challenging. Sometimes your borrowers need to understand the consequence of negative leverage. I mean, if they're really excited to buy that $15 million shopping center and they're getting it under contract at 5.5 as a capitalization rate, and your loan rate's 6.5 or 7%, they may not be thinking through what that really means to them, and having the knowledge and equipment to be able to say, hey, I'm not saying this is a bad deal. I'm not saying I don't want to do the deal. I'm not saying I won't do the deal, but I want to make sure if you've been a longtime customer of the bank or a good customer of the bank that we're sharing our knowledge and our education resource with you to make sure that you're getting the strength of investment that you think you're purchasing. Sometimes people make those decisions independently, and then a year later, they get frustrated. And for whatever reason, it's always a blame the bank kind of thing. Like, why should it be the bank's fault that you didn't understand if you buy something at a 5.75 cap rate and you paid 7 on your loan, that might not be the greatest long-term investment. That shouldn't necessarily need to be our job, but if you don't have those conversations on the front end, you can set yourself up for some harder conversations later.
Yeah, I completely agree with that, and I think that's one of the things that when I first came on board, I came from a larger institution and had worked in commercial real estate deals and CNI credits and stuff like that, and had a pretty diverse background moving into the position at the Bankers Bank. And I work with a lot of smaller community banks across our 6-state region, where they may only see a few large, really complex deals a year. Like they're not doing 4 and 5 of these at a time. It's like they may have one here or another. They have one really good customer that sends them a deal about every 6 months or so. And starting to have conversations with them, they would come to me asking me questions and advice. Well, hey, I've got this deal. I'm not sure how to structure this. What's your thoughts? Have you ever done this type of property? And being able to use my experience and just kind of educate them is what kind of led us to kind of developing our credit conference. Because we started looking at it like we are kind of a accumulation of knowledge of all these bankers that we work with. So a lot of times, we see, for every one credit our one of our community banks see, we've seen 12 of them. We've worked in markets like Nashville and some other areas where they'd like to, possibly portfolio some assets from that market because it's a strong market and there's not enough demand in their smaller communities. But they just don't have a really good firm knowledge of what's going on in Nashville. They just kind of know the high level, it's really growing, things are going well. So we've tried to become that kind of expertise in the different areas that we work at, kind of really developing and understanding what's going on within the industry that the smaller community banks should be able to take advantage of if they had the proper understanding and knowledge of the risks that's involved with it in the process of underwriting it. So by establishing the credit conference, we feel like that's a way for us to bring them together, allow them to network with each other, get some really good information to take away, and then some resources that they can reach back out to. So I know we've had you a few times at our credit conference. We're going to have you there again this year. So some of the things I know that our banks are really going to be asking questions about is the change in the liquidity in the market, the change in the cost of funds and the pricing, and then the impact that's had on investment portfolios. I think banks are going to be reassessing their asset liability management and what kind of assets they're putting on their books. So as we kind of approach the credit conference, is there anything that you kind of see that's going on with your institution that's really changed maybe kind of your approach to assessing not maybe just the credit risk of deals, but different areas where you guys may be looking at trying to onboard some earning assets that kind of changes the risk profile a little bit and maybe alleviate some of the interest rate risk that comes with more of a treasury solution, but kind of shies away from some of the credit risk that we're kind of concerned with when we kind of look at the current environment.
Yeah, that's probably a far more complicated question than the minutes we've got remaining, but I'll give a swing at it. You've got a lot of banks, especially those that had bigger mortgage operations, are having challenges in their accumulated other comprehensive income, which for most of us right now is actually accumulated other comprehensive loss, which is frustrating. You've had a lot of changes in the mark-to-market side of bond portfolios or other investment classes. So I think as you try to navigate that reality of the securities portfolio, there are some credit risk questions that probably need to be asked and answered. There's also some tolerance questions. Um, I know a few organizations that are reaching towards the top of their policy guidelines, not because the bank did anything wrong or improper, just the change in market conditions have pushed them towards the top of their ALCO considerations. Um, I attended a Piper Sandler conference about 2 weeks ago, and the guys from Piper were making a pretty compelling argument that it might be time to consider liquidating some securities either at par or even at a slight discount so that you can redeploy them into earning assets because you'll earn it back fast enough to maybe make that make sense. And that may or may not be applicable for some of the banks in your group, but I'd imagine for a few of us, there might be reason to have that consideration. On the earning asset side, at least what I'm seeing in the general marketplace is we're seeing some banks that have pulled back a bit from the heavy production front and looking to be a little bit more um, selective in the types of credits that they'll onboard. We're seeing that both in terms of pricing, like our loan committee just had a deal that was from a credit quality perspective, it met all the parameters that we would want to see from a credit risk perspective. But the borrower wanted a 6% fixed rate for 5 years. And from an ALCO consideration, we felt like we could do better than that with other assets. And it was just a transaction. And I think that's the statement that a lot of banks are going to be struggling with here in the near term is if it's just a transaction, does it have a strong enough credit risk profile to warrant doing? And if my loan to deposit ratio is pretty low, the answer to that might be different than if my loan to deposit ratio is pretty high. So I think there's a balance there for finding the right set of transactions if you're looking at transaction lending that registers in the credit box, that pays an acceptable rate of return, but that doesn't necessarily equip you to have other deposits or other ancillary services. So, as we move towards the conference, that'll be one of the sessions, Derrick, the session you guys have asked me to talk about is one of the alternatives that our bank has found to the securities portfolio, which is our single tenant net lease investment real estate group. Those function very similar to bonds. I mean, they're typically very low leverage in the 50 to 60% loan to value range with an investment grade paymaster. We've got perfected into the payment stream, so we're getting paid directly from the tenant to the bank. We take our loan payment out, and then we allow the borrower to come in and access their funds. So it fits kind of in between that bucket, but it isn't right for everybody because it's got a pretty low coupon on it relative to what you're going to get in your loan portfolio elsewhere. But it avoids the mark-to-market risk and some other compelling pieces. And there's opportunities like that out there. We're not really big in the solar cap loan side of things, but there are some opportunities where your bank might be able to finance solar investment. It's got a little bit better interest rate, but you're taking a bit more credit risk, at least in my opinion on those, and probably more than you could learn from other providers there. Low-income housing tax credits, seeing a number of those come back into the marketplace, a little bit heavier than what I've seen previously. And that might be something that can kind of fit. Those historically have had a pretty low default rate on them and might be an attractive asset for something different. And I'd imagine those are typically large enough that Derrick, your organization probably has a few of those that you're looking at any given point in time. So I think there are a number of alternatives to your securities portfolio. The question is, how do you best recognize those? And that answer will vary for every ALCO committee that's on the call.
Yeah, I know it's there's options out there that I've kind of had come across our board that sometimes make sense for smaller community banks to kind of look at. I think the low income housing tax credits actually are a really good investment but there is a little bit more of a learning curve associated with those. We've seen I haven't seen anything on the solar cap. That would be new to me, and that would probably take me a few deals to look at before I can get comfortable with actually, really putting any thought behind one of those. But I have talked with you a little bit about the triple net lease loans that you guys have looked at. And I think that the one thing that's attractive about those is the underwriting on them is, very similar to what you would do on any commercial real estate deal. I mean, it's not something that would be completely, different or outside of the box of what banks are currently doing. It's more of just looking at it differently than you would with a, small strip center in a rural community with mom and pop storefronts. It's now a single use tenant in a national, chain. So I'm really excited to give our banks an opportunity to kind of hear what you guys have done and how you've been able to develop this network of opportunity to invest in that type of asset, and really to go outside of what you do with any commercial real estate deal. But just really kind of classifying those as like, all right, the difference is going to be the pricing. At the end of the day, we're going to have a very low leverage, very strong, tenant support with, the recourse and stuff that you guys require. I'm very excited to give our banks an opportunity to kind of hear and have the conversations that you and I have had around that product that you guys kind of develop within your bank.
Yeah, I mean it's an exciting business line. It's decidedly different from what some other banks might be doing, and yet it fits very cleanly in that commercial real estate vocabulary. So it won't be hard for folks to really be able to get their arms around. It's a little bit of a different underwrite in that we're going to spend a lot more time going through the lease than what you might on a multi-tenant transaction, because there's one lease. I mean, it's kind of the running joke. What kind of vacancy rate do you put on a single tenant property? You're either 100% full or 100% empty. The 10% vacancy rate is really just not that relevant. So trying to make sure that you understand the paymaster, make sure that you understand the quality of the lease that's been signed, and what it obligates each party to, takes a little bit larger consideration when you move into that particular space.
Yeah, as well. I'm again in advance want to thank you for agreeing to participate in our credit conference this year and for being with us today. I know that you have a lot going on, and your time is valuable, but we really appreciate you giving us the opportunity to just kind of have this discussion. I'm really looking forward to the credit conference in May, and obviously, I would highly encourage anybody who is looking at sending one of their uh, you know leaders within their bank or their organization to graduate school banking to consider the GSB Wisconsin, just based off of the experience I had with you and several of the other faculty members there who come from real world situations. Your chief credit analysts, chief lenders, people within these organizations are actually doing it on a day to day, and then coming up there to kind of help teach some of us younger guys. I don't know how much younger I am than you, but younger in experience maybe. And what needs to be done within your organization to really make sure that you are continuing to grow and continue to engage your staff in a way that it helps them grow as well. So, Derrick, I always appreciate you and everything you've done for me in my career.
Well, thank you very much. That means quite a bit. And very much appreciate the opportunity to speak to everybody, and hopefully pay forward some of the people that invested heavily in me early in my career. So I'm excited to be at the conference again and look forward to seeing everybody there.
Absolutely. We look forward to having you. What can you kind of, before we let you go and sign off, if you want to give a little plug for the credit conference and maybe your presentation in particular, what value do you think, lenders and credit teams are going to get from attending?
What I have always found to be true about conferences, the classwork that you do is important. You will find value in every session that you go to. It might be a single nugget of wisdom or a reminder of something that you've lost track of over time, or circumstances have changed and it's now important again, even though it wasn't important previously. To me, those are always important. The session that I've been asked to talk about is somewhat specific to that investment alternative in the triple net lease investment space. I think some people will get some maybe different takes on how to underwrite a commercial real estate deal, and maybe the importance of considering the lease and how that fits in the overall structure of things. Having said that, I have also found throughout my career that the benefit from conferences is in the networking exchange that you have in between sessions and after sessions and at dinner and at the bar. Those tend to be the ones that pay the greatest dividends over time, because if you walk out of that conference and you've got three new people that you can contact that do kind of what you do, but differently, then to Derrick's earlier point, when you come across that deal that's just a little bit too different from what you ordinarily do, you now have a network of people that you can call that you know and that know who you are, that you can say, I'm just not sure what I should do with this. Can you help? And to me, that's the true value proposition in many of these types of events. It's the classroom knowledge is always good and it's always helpful to go through again. But that exchange, that free exchange of conversation and ideas in between sessions or at lunch or whatever, to me is where the biggest bang for the buck comes from. And what we learned, or what I learned in COVID, Zoom and Teams do great at many things. They don't do anything to give you that last piece of that value proposition that you get from being in person. And that to me is the piece I would say that makes these conferences worth attending, is that interaction, free exchange of ideas amongst your peers.
Absolutely. Absolutely. Well, Derek, thank you so much for joining us today. I think you've given us a lot of really great information and things I think our community bankers will really benefit from. And thank you for attending and presenting at our credit conference. We're looking forward to that as well. And just, as always, thank you for everything you do for our community bankers.
Well, thank you all much for having me, and look forward to seeing everybody soon.
That was Derrick Jackson, the Chief Credit Officer at First Savings Bank Indiana and a keynote speaker at our credit conference. I thought he had some really good things to say, and I'm looking forward to hearing him at the credit conference. Speaking at the credit conference, Derrick, why don't you give us a little bit of an overview of some of the value you think that attendees are going to walk away with?
Yeah, and absolutely. Derrick Jackson is always somebody that I find to be very sensible and have a great knowledge of how to approach, credit risk management. And, so it was awesome to kind of talk with him again today. And the topic that he'll be talking about at the credit conference, may have of interest to a lot of our respondents are looking for alternative investment, assets besides, investments in treasuries and loans and stuff like that. So, just something else that Derrick has kind of looked at as an alternative to maybe the way that we've always done things as community bankers. So looking forward to that. But in general, our credit conference it was kind of established as for two real main purposes. One, kind of create an opportunity for our community banks to collaborate with our staff, and for us to collaborate with them, and then also with other peers from across the region. And really, we try to focus on, finding really valuable information on what's going on in the current economy and the current credit cycle that we live in, and bringing in practitioners like Derrick and other speakers who can kind of give them some insights into things maybe they know, and just making sure that they're, doing everything they need to, given the current environment. So it's a really great opportunity, especially for your higher executive level officers that are managing that overall credit risk. But even for like the credit analysts and the lenders themselves, they're out, trying to discuss, loan structures with their borrowers, or analyzing those credits. We do have a pretty diverse speaking group and breakout sessions, so can really value pretty much anybody who attends.
Yeah, for sure. I got the chance to attend last year, and I can definitely see how, a lot of the information presented would be extremely valuable to, lenders and, C-suite executive level credit and lending professionals. And I got a chance to talk with some of the attendees, and many of whom are longtime customers of ours, about the conference, and they'd been over and over, and they hands down said it was, one of the best conferences that they attend in a year. And so I'm looking forward to it, and I think there'll be a lot of value there for our community banks. So if you're listening and you want to attend our credit conference, register now at icbbcreditconference.com. Early bird registration closes March 15th, and registration itself closes April 30th. The conference is May 3rd through 5th at the Central Bank Center in Lexington, and I really hope you guys can make it. Thank you guys so much for listening, and I hope you've gotten some value from this conversation to take back to your community bank. Make sure to follow or subscribe to The Correspondent wherever you get your podcasts and turn on notifications so you never miss a new episode. See you next time.